Welcome to the top 9 ways to lose money in the market. We'll focus on day trading and discuss the most damaging techniques that traders use, which typically result in losses to both their account and their psychological health. Number 9. Negative bias buried in percentages. It can seem as though you're fighting a losing battle when it comes to trading, and that is to some degree due to the negative bias buried in percentages. And I'll show you here with a quick diagram. Let's suppose you've got $100 and you lose 10%. Well, that's going to leave you with $90. 100 minus 10% is 90. But if we add 10% back, so we've got 90, we'll add 10% back, but that brings us to 99. We don't get back to 100. So now we've got 99 and we'll minus 10%. Well, this brings us to 89.10. And now if we take 89.10 and we add 10%, we get to 98.01. So what's happening is, if we just repeat minus 10 plus 10, minus 10 plus 10, we actually drift lower and lower, and we'll eventually get to 0. And you might think, well, that's because we started with minusing 10%. How about if our trading balance was $100 and we started by adding 10% and then minus 10 and then add 10? Well, unfortunately, we still get to 0. You can try this for yourself with a calculator, or I've actually created a video illustrating this frustrating phenomena and how it affects traders and stock investors. I'll put a link in the description. The video is called Do Stocks Have Entropy? Okay, so the next thing I want to talk about is number 8. Slippage, spreads and fees. These are the things that a lot of traders, especially newbie traders, don't actually consider, but they can be disastrous on your account. Let's start with slippage. Slippage can affect you whether you're going long or short. It just means that where you think you're going to get filled or enter the trade, there's actually a delay, so you get filled at a worse price. I can pick any chart. I'll just use this chart, and let's assume you want to go short, which means you want to make money when the stock goes down. I'm going to draw a line along there, and let's just assume that you want to go short below that line and ignore everything that happens after this big red candle. I want to focus on this red candle here. So let's say you put an order to go short there. So you believe that when the price comes down, it's going to fill you and you'll be making money as the price comes down. But this is a 1 minute candle. It's very volatile and the price dropped much quicker than you thought. So actually, it's quite possible you could be filled all the way down here, which means 1 minute later you are immediately underwater because you're short and the price is now higher than your entry. Your entry is here instead of where you thought you'd get in. So that's one thing to be aware of. That's slippage. The other thing is fees. Now, most brokers will charge a fee, whether that's $3, $5, whatever it is, to enter a trade. Sometimes it's based on how many shares you buy, sometimes it's just per trade. But a lot of brokers nowadays advertise no fees or 0 commission. This to me is wrong, because what they do is they just simply add spread. So they take away the fee, but they add a bigger spread, and that spread is going to cost you probably more than the fee. Let's have a look at what spread can do to your account. Okay, spread is just simply the difference between the bid and the ask, the buyers and the sellers. So if you wanted to buy here, say the current price is $19.50. Well, the nearest seller may say, well, actually, I want $19.60. So you'd actually get filled higher than where you press the buy button. If you're buying with a market order, you'll always be buying at where the sellers are willing to sell, and that difference is a spread. Sometimes the spread is just 1 cent. Sometimes it can be as much as a few dollars if the stock price is very high and liquid. So you're always starting off a trade in negative. You'll never get filled at the exact price that the market's showing. This is why it's difficult to make money as well, because not only have you got to be aware of slippage, but you're also paying for a spread and sometimes additionally fees to the broker. And if you Google trading with no fees, you can see a long list of no fees, no commission. See, it says here only spread. But this is very sneaky, because all the brokers do is, whereas a natural market spread may be, let's say, 10 cents between these two lines that we looked at earlier, what the brokerage does, it just increases the spread by, say, another 4 cents. So when you press the buy button here, you're getting filled all the way up here. Now obviously this isn't to scale, and it probably wouldn't be this dramatic, but the point is you are paying a fee. And even a 4 cent spread, if you're buying 100 shares, that's $4. You buy 100,000 shares and you're now paying way more than you would be paying for a normal fee. So for me personally, when I find a trading platform, I want to pay a fee. I don't want them to add to their spread. And something to be very wary of is, and I'm actually going to do a separate video on this because I think it's really bad. If you go to a trading platform, they'll actually tell you if they add additional spread. They mostly do, and it's somewhere around 2 to 4 cents. And you've got to be really careful, because take this company here, for example. They say on share dealing, they add 4 cents per share additional spread. This is additional spread, you can see. And 4 cents per share is pretty standard. It's typical within the industry. But this asterisk here, leading us to the small print, basically says, and this is really bad, additional spread is the spread this company adds to the market ask and subtracts from the market bid. Now I emailed them about this, and they said, yeah, they add 4 cents to the ask, plus they subtract 4 cents from the bid. That means that's an 8 cent spread, not a 4 cent spread. So not only are companies saying they don't charge a fee, they're even being a little bit sneaky with telling you exactly what spreads they add. So this is something you've got to be really careful of. Find a platform or a broker that is honest about what additional spread they add. Don't go any higher than 4 cents per share. Somewhere between 2 and 4 cents per share is fine if you're intraday trading, and that's what this video is primarily about. It doesn't matter so much on swing or long-term trading, but in intraday trading, sometimes some traders are scalping 10 cents, and that's all they get. They want to make a 10-cent profit. So if you're paying 8 cents spread, you're never going to make any money. I just want to drive home the imbalances between your winners and losers. Let's suppose you have a winning trade and it moves in your direction. Assume you have 100 shares and the move was 50 cents. So that's a nice trade. 100 shares times 50 cents would give you $50 profit. But of course, we need to add on slippage. So let's just add on, say, 8 cents of slippage and 4 cents of natural spread. I won't even add additional spread that the broker may add. So now your move no longer is 50 cents, it's 38 cents. So 100 shares times 38 cents is $38 profit. But let's take off $4 for the brokerage fee. It's probably going to be more than that, and that leaves you with $34 net profit. Your fees will probably be double that because you pay to buy and you pay the same again to sell, but let's just leave it at $4. Now an identical move against you. Let's suppose you have a loss of 50 cents. Now you have 100 shares, you've lost 50 cents, so your total loss is $50. But of course we have to add on slippage, which we'll probably get, and 4 cents natural spread, exactly as we did in the other scenario. So now our total loss is $62. But of course we need to now also add on the fee, so that gives us a total net loss of $66. And this is a problem with trading. Your losers are just naturally going to be bigger than your winners because of the nature of fees going against you. Just before I go on, if you want to be notified about the latest growth stocks which have pulled back considerably to a support area, then subscribe, then you'll be notified. I do videos daily or every other day if I can't get around to it. But yeah, if you hit the subscribe button, then you won't miss out. Number 7 is greed. You're going to see lots of this, Lambos and traders showing you how they make 100 grand a day, sexy girls, money in cars, all sorts of things. And this is really damaging because greed is closely associated with rushing, trying to run before you can walk. And if you want to be a successful trader, honestly, greed is one of the biggest obstacles you'll have to overcome. Greed is far more dangerous than any other emotion for a trader, prompting you to overtrade and act basically irrationally. So you have to learn to ignore the gurus and their Lambos and realise that trying to get rich quick will lead to repeated account blow-ups. It's unsustainable. So the most dangerous thing you can do in trading is over leverage. Leverage is the ability to make large trades in the market with only a small amount of capital in your account. And brokers will typically give you 5, 10, sometimes 100 times your buying power, which may seem like a great deal, especially if you haven't got much money, but it's a double-edged sword. Trades rarely go in your favour straight away, so you have to be able to manage the pullbacks. If you're over-leveraged, you will either be stopped out over and over and over again, which, taking those small losses over and over really adds up quickly, or you'll get trapped in a losing trade and suffer enormous losses. So you have to remember, with 10 times leverage, your gains, yes, they can be 10 times as big, but it's more likely that your losses will be 10 times as big. And the thing is, you may win 5 times in a row, but the one loss you have with huge leverage, it will just wipe you out. So it's not sustainable to trade with huge leverage. And on a side note, I strongly disagree with traders giving the illusion that you can make loads of money really quickly. It's a false promise. Day trading is about the hardest way you can make money, so don't enter into it with any illusions.